Today we are going to start the sessions on risk management, but probably we may not be able to continue this next week as well, because still there's a part on the ALM to be completed. So probably that will be done next week or the next 2 weeks. However, today we'll start this risk management module. Today I'm hoping to give you a brief introduction, and if time permits, we can discuss about liquidity risk. Some topics related to this you may have already discussed in ALM. So the outline, I'll give a brief introduction on it. What is risk and risk management? Then we'll discuss what are the types of risk that the financial institutions face. Then how do we manage liquidity risk, market risk, and credit risk? Broadly, these are the things that we are going to discuss under risk management. And because this is a treasury program, we are not going to discuss every aspect of risk management, but mostly risks that are related to treasury operations or treasury activities. That's why liquidity risk, market risk, credit risk are more important, and we focus mainly on these three, and we will go into more detail in market risk. Then we'll discuss how to identify your market risks, how to measure that, and what are the ways of mitigating or controlling the market risk, and what are the tools available, and how do we use to hedge your market risk, different market risk, categories of market risk. We will discuss those in coming weeks. So first thing is, what is risk? So according to the ISO 31000 standards, risk management standards, they define the risk is the effect of uncertainty on objectives. So we all have different objectives, and we do a lot of activities with the aim that to achieve those objectives, but there may be a lot of uncertainties in between that. When we started this program in January, we never thought that we may have to conduct classes online like this. We were supposed to come to a classroom, have a very interactive session, but for whatever reason, we couldn't do that. Few months we couldn't do anything. So that is risk. Our objective was at the beginning is to conduct the classes and give you the knowledge on treasury management, risk management, and have interactive sessions, enhance your knowledge, and test your knowledge and award certificates. But on the halfway through, what happened? There were barriers that we couldn't meet each other, we couldn't conduct classes. So ultimately, there's a threat that we may not be able to our objectives. Now, what has happened? We have find out some different ways to do that. So that happens everywhere, even in our day-to-day life. So we have objectives. We do different activities, having some objectives in our mind. We try to achieve those objectives, but there can be unforeseen or unexpected events happening in between. So that is risk basically. So now in this course, we have to focus what are the objectives of a financial institution, and especially to achieve that objectives of the financial institution, what is the role of Treasury and what is the role objectives of Treasury. Then what would be the risk that Treasury would face and how do we tackle those risks. That's the main idea behind this module. So the previous one, it's a standard for the risk management generally, but we are going to discuss about financial institutions and risk to the financial institutions. So if we specify the risk in relation to financial institutions of finance, again the risk can be defined in different ways. There are different definitions. So however, this is one of the definitions I found on Investopedia. It says the chance that an investment's actual return will be different than expected. Risk includes the possibility of losing some or all of the original investment. So in finance or in financial institutions, what do they do? Or the ultimate objective is to make profit and increase the wealth of shareholders. That's the ultimate objective. Meanwhile, you may support the economic activities and all those things are there. So when we make an investment, we expect some return. But the actual return what we get at the end may be different from what we expected. So that difference, that's the risk. We may not realize what we expected. So or we may realize, oh, we may lose everything. But not only the part of our return that we expected, maybe we may lose our original investment as well. So we won't get anything, 100% loss. That can happen. So that is the risk that we face in finance. But if you do a search, you may find different definition with regard to risk. Sometimes in some instances, they mainly focus, when we talk about risk, you think only about the financial risk that you may lose money or you may not able to get the return that you expect, things like that. But in broad perspective, it's not the risk. It's not only part of risk. There are more than that financial risk. Financial risk only one component of risk. So as defined here, objective may not be financial. It may be some other qualitative objective. So therefore, risk is very broad. Risk management, it's very broad. We can have a separate course on that. That's why even in IBSL there's an integrated risk management diploma separate, because it's very vast. So therefore we are not going to discuss every aspect of risk here, but mainly focus on what are the risk applicable for the treasury operations. So in risk, there are two characteristics. One is uncertainty, and the other one is loss. What is uncertainty? That we don't know what would be the outcome. There are possible outcomes. For one action, there may be several possible outcomes. There are chances of happening all those outcomes. There's no certainty that if you do this, this would be the outcome. For example, in the our context, if you buy a bond today, what would be the outcome? What do you expect? You expect a coupon payment every 6 months, and on the maturity proceed, face value and the coupon. That is our expected outcome. But in between that, for whatever reason, we may not receive coupon on time, or the issuer may default, or the yield changes, yield increases, then the value of your investment may go down. So therefore, our outcome is not what we expected at the beginning. So as I mentioned earlier, when we started this program, we didn't expect this type of events to happen in globally or within Sri Lanka. So, but we had to face that. So this is uncertain. It's not like happening for 100% sure. But what is lost due to those uncertain event, we may incur losses. So in this, if we again discuss about our course, we lost 3 weeks. We couldn't conduct classes for about 2-3 months. So that's a loss. It may be a financial loss or maybe some other kind of loss. The loss happened because of this uncertainty. The risk becomes a reality. So therefore, unwanted consequences, we have to face unwanted consequences, or that may lead to a loss. So that's the characteristics. The risk is uncertainty. The result is a loss. We can say like that. Then there's another way of looking at risk. Risk can be a threat and opportunity as well. Sometimes it can be a opportunity. We have the uncertainty. That uncertainty itself gives us a opportunity. So in financial market, we will discuss this in future, but interest rate changes very frequently. What would happen if interest rate increases? As a lender, prospective lender, that means you have not already lent, but you are about to lend. But interest rate increases. It's an opportunity. Why? You can lend it at a higher rate. But as a borrower, it's a threat. You wanted to borrow. Before you borrow, interest rate increases. So your interest expense increases. That is a threat. But the risk is the volatility in interest rate. That means frequent changes in interest rate. That's the risk. We never know what would happen to the interest rate in future. That is the risk that we are discussing. But that risk may be opportunity or a threat, depending on what is your expectation. So remember the difference between threat and opportunities, as well as the risk is not a loss. Loss is the realization of that uncertainty. Uncertainty is the risk. Since we don't know what would happen, that is the risk that we face. if that happens, what is the loss that we incur? That is the outcome. So then, if we know, we have some idea about what is risk, then what does it mean by risk management? That's a process. Management, you might have learned management. Again, management, you can define it in many ways, but basically it's a scientific process, or very well organized, very known process. So even here, risk management, it is the name given to a logical and systematic method. So there's a way of doing things. Do what? Identifying, analyzing, treating, and monitoring the risk involving any activity or process. Any activity or process. That's very important, because depending on the activity, depending on the process that you follow, there may be different risks. The risk management process, or what does it mean by risk management is, you have to identify what are the risks in that process or in that activity, then analyze what would be the consequences of that risk, then treat, what do we do if that risk event happen, or whether we take that risk, or whether we want to avoid it, or we want to control the risk, minimize the risk, or we want to completely eliminate that risk, or we can transfer that risk to someone else. We'll discuss how to do these things in future. And meantime, we have to monitor what are the developments, whether our risk level increases or decreases, whether there are new risks arising that we have to do. So doing these things collectively in a systematic and logical manner, we call it is risk management. Who should be responsible for this? That's another important thing. In your organization, there may be risk management department or chief risk officer or separate unit for risk management, but don't expect them to manage risk. It's not the objective of having a separate risk management department or risk management division. Generally, everyone in the organization, from the very top to the bottom, everybody is responsible for the risk management activities, but at different levels. As a teller in a bank, he or she has a responsibility of managing risk in that process that he is or she is teller is carrying out. And they may see different risks. They have the responsibility to report those risks to the top management. There should be established reporting lines, assigned responsibilities. That has to be there. So generally, what I wanted to highlight, everyone is responsible for risk management. The role of the risk management department or the risk management division is to make sure that there's an established procedure of risk management, helping the business unit to identify the risk, to assess the risk, whether they follow the procedure, to make sure that they follow the procedures and they are within the limits emphasized, helping to measure the risk and report those risks to the top management as a whole organization perspective, not individual lines or not in silo basis. So this is another definition for risk management. Again, it's linked to the financial risk management. So it's the practice of creating economic value in a firm by using financial instruments to manage exposure to risk, particularly credit risk and market risk. When it comes to financial institutions, so as I mentioned earlier, market risk, credit risk are the two major risks. Apart from that, liquidity risk is also important when the financial institution is a deposit taking institution, or when you have large obligations. But in general, financial risk not necessarily in all financial institutions may not face the liquid risk, but may not be a very important factor. But like banks and finance companies, they need liquidity to meet their day-to-day obligations. Therefore, liquid risk also important. So the summary is here is financial risk is related to market risk and credit risk. Financial risk management is related to again, but these previous activities, even in financial risk, we have to identify, we have to analyze, we have to treat and monitor the risks arising through this market risk or credit risk. How do we measure credit risk? How do we measure market risk? How do we identify what are the types of market risk? What are the types of credit risk? Those are very important. How do we treat different credit risk or market risk? And how do we monitor those things? And how do we control that? That is the risk management definition. And as in these definitions, it's a systematic method, logical and systematic methods. So risk management itself a process. Again, if you read different textbooks, various textbooks, there may be different risk management processes defined in different books. Even you do a search in the Google or internet, whatever the browser or the search engine that you use, you may come up, you will find different processes, but basically the steps may be different, number of steps. Now here there's only 5 steps, that may be different, but basically key concepts behind all these steps are the same. So in this, there are 5 steps: establish, identify, assess, evaluate, treat. That goes in a cycle, and overall, all over these, there should be monitoring and review and communication and learning. So in some textbooks, so this monitoring and review may be part of this cycle. You can represent this in different ways, but basic concepts are the same. The first step, establish. What does it mean, establish? First, we have to identify what is our business, what is our objective. In risk management, what is our focus? Are we going to manage or cover all risks that may be relevant to us, or only part of those? And what are the procedures? What is the governance structure in an organization with regard to risk management? The establishment of all these policies and procedures, is this covers under this establish. Then the identify. This is the process of identifying the risk. We have established what is our business, what is our objective. Then the next step is to identify the risks that may have impact on our objectives. Once you identify what are the risks, then you should be able to, or you should do assessing, assess the risk. Each and every type of risk, what would be the, oh, how to measure these risks. Basically, how do you measure these identified risks? So you know that duration is a measure of interest rate risk. Likewise, what are the measures that we can use to measure the risks identified in the previous step? Then evaluate. Once you measure, you have to think about whether this is acceptable or not. What would be the impact on our business? What would be the objective? Sorry, what would be the impact on our objective? Whether we can tolerate that. That evaluation has to be done at this stage. Then treat. You have identified what are the risks. You have ways of measuring those risks. Then you have measured that risk and evaluate what would be the repercussion. Then you have to decide, what do we do this? Are we going to take that risk as it is, or we want to minimize that risk, or completely eliminate that risk, or whether we can bring it down to some acceptable level, control the risk. Or the other option is you can transfer that risk to someone else. So for example, you might have bought a life insurance. Why? There's a risk. For some reason, we may face unfortunate events and we may lose our life. But then we have our dependents, so we need to protect them. If we lose our life, our income for the dependents may not longer be there. So there's a risk. They face difficulties. To avoid that, we buy life insurance. If any event that happens, then the beneficiaries of that life insurance will get some benefit from the insurance companies. But we have done that. In that process, we have transferred our risk to the insurance company. The same thing if we buy a insurance or motor vehicle insurance. If an accident happens, the vehicle is repaired at the cost of insurance. Our cost is just limited to the premium. That is transferring risk. So buildings, you get fire insurance. Why? To protect or to get the compensation if such incident happens. We cannot control that risk or absorb the loss, not the risk. We cannot absorb that loss, so we transfer that risk. But we try to minimize that with establishing proper equipments, and other safety features when we construct the building. So these are the risk control mechanisms. Even after setting up those controls, still there's a risk that the building may caught a fire. That can happen. You have all equipments, fire extinguishers and all those things, but still that can happen. So we call that residual risk. Even now, so first we identify what is the risk. Okay, the building, the risk is getting a or having a fire in this building. That's the risk. Okay, what are the actions that we can take? How do we treat that risk? We can establish or set up necessary equipments in the building. First thing is we have to avoid, say, take safety features first when we lay out electrical systems and things. Follow the proper standards and minimize the risk of having a fire. Then even if there's a fire, how do we fight against that? We need some equipment in each and every floor in in different places. We place those firefighting equipment. All those are risk mitigating activities. So we have done all those things. Still, there is a risk that the whole building may caught up by a fire. So that is the residual risk. Even after putting all the controls, or whatever the possible controls that we can put, still there may be a risk. That is we call residual risk. So then we have to decide what do we do with this residual risk. Are we going to accept that residual risk, or are we going to minimize it further down to acceptable level, or we want to treat it, do something more, or we can transfer that risk to someone else. That is happening in this treating level. But the things that we are going to discuss in future with regard to market risk and credit risk and liquidity risk, mostly we focus on this treaty. What are the things that we can do to minimize these things or transfer our risk to someone else? That is treating. We will mostly focus on this treaty. And again, you can see this is a cycle. All these activities going around, and that means doing repeatedly, because business may change, business environment may change, therefore new risk may arise, then the assessment method we may have to change, the technology changes, then the evaluation methods, there may be much more sophisticated evaluation methods come up with the time. There may be new products that we can use to treat the risk. So this is a never-ending process. And in the middle, we can see monitor and review, because we have to continuously monitor these and review these things. That's why it's going in a cycle. Then the other part is the most important thing: communicate and learn. Someone in the top, maybe risk committee or someone, may have set up nice procedures, how to do risk management, how to control these risks, what are the limits, things like that. But that has to be communicated from top to the bottom. Assign the responsibilities properly. Then only the staff of the organization, officers of the organization, people in the organization know what is their responsibilities, what is their role in risk management. If something happens, what to do. You have the proper document, but if it is not communicated to everybody, they don't know what to do. So therefore, this communication is very important. Not only establishing procedures and policies, that has to be communicated to the people in the organization. And the other thing is learning. It's not that in identifying process, it is not possible to identify each and every risk. There are a lot of risks that we have never seen. There may be new things happen, but yes, we may put some policies, procedures to address somehow that unforeseen things. But if something happens new, then we have to learn through that. It not necessarily the thing happen in your organization. It may be something happen, risk event happen in another organization. That's why, again, the communication, not only internally, with external parties as well, is important. That's why in Basel Accord, they mentioned that within the financial institution, there should be communication with the supervisors, central banks or other supervisors. There should be communication. If you see some risk event happening in one bank or one financial institution, that should be communicated to others as well, but not the firm specific factors, but general factors about this event. Then others can learn, okay, this is a new risk, so we have to take actions. So therefore, this communication and learning through the events is very important. So, though risk management was there for decades, I think after 2008, 2009 crisis, lot of theories, lot of procedures, lot of measures, lot of risk management practices emerge because people learn from the event happened in 2008 and 2009 global financial crisis. So though we have not faced that much to that financial crisis, still there are things for us to learn, to improve. So therefore, it's very good to be in touch with what's happening around the world, in other countries, in other banks, and assess what would be the possibility. If that happens, what would be the loss for our institution. That is very important. Learning. So this is a brief introduction about the risk management process. As I mentioned at the beginning, even this identification or the assessment, these steps in some books, they may break it into several parts and have a separate structures or processes, but basically these things are the common concepts in any of these processes. So with that, we'll move into what are the risks that financial institutions may face. Again, we can break that into two parts. First one, financial risk. The other one is non-financial risks. That's the broad categories of risk faced by financial institutions. You may think in a financial institutions, financial risk is the most important thing. It's not necessary. And don't think financial risk is the financial loss. No, it's not. The financial loss is the ultimate result. If you can remember, uncertainty and loss, two different things. Financial risk is the uncertainty that we face in the financial variables of in finance. Non-financial risk is the risk in our operational activities, whatever the models that we use in the risk event happening in the environment, like this pandemic events, things like that. Those are non-financial risk. But whatever this risk, the ultimate result would be a financial loss, not necessarily. Again, even a financial risk event, it may not gives you a financial loss necessarily. But even a non-financial risk event, that may gives us a financial loss. So, and our objective is not only to avoid financial losses, as mentioned earlier, whatever the barriers that we may face to achieve our objectives. We may not be able to achieve objectives due to these risks. That is the main point here. So with that, we'll go into details. Financial risk and non-financial risk. Financial risk, as mentioned earlier, liquidity risk. The liquidity risk is very important for financial institutions that we discuss here. Banks and any finance companies, insurance companies, and things like that. And market risk. Market risk is again divided into four: interest rate risk, FX risk, equity risk, and commodity risk. Then the credit risk. Liquidity, market, and credit are the three main financial risk. Then market risk is divided into four: interest rate, FX, equity, commodity. Basically, market risk is the risk a financial institution may face due to changes in market variables. What are those market variables? Interest rate, foreign exchange rates, equity prices, and commodity prices. Because many financial institutions, global financial institutions, take these or has some exposures to these variables: interest rate, foreign exchange, equity, and commodity prices. So price, the other word that we use to market risk is the price risk. Market risk and price risk is same, because interest rate we can consider it as a price of money. Foreign exchange risk, again it's a price of foreign currency. Equity risk, it is the price of equity. Commodity prices changes, that will give us some risk. So therefore, market risk is sometimes also known as price risk. Credit risk, as you know, credit risk is the inability of borrowers to pay back on time. So we'll discuss more details about financial risk factors later. Then other side, non-financial risk. previous or few years back, it was mainly focused on operational risk. What is the operational risk? It may be a human error or system error or the failure to follow the procedures or lack of procedures. These things fall under operational risk. Due to pandemic, what we face this operational risk. Then the model of, say, now we are doing these online classes. What are the risks that we may face? Lot of operational risk. What would happen if power goes here? Then we may not be able to, if there's a power failure here, we may not be able to conduct this class too. So there may be interruption. Or if a network failure. Or this PC, if it is break, what would happen? We may not be able to conduct classes. So this is the operational risk from this side, my end. But on your side, again, same thing. If what would happen in your area, there's a power cut, then you won't be able to attend the class. If you don't have enough quota in your data package, you may face some problems. So these things are operational risks. So even in financial organization, these things can happen. There may be procedures to follow. When you grant a loan, there may be a procedure to follow. You may follow the procedure correctly, but still there may be a risk. The procedure may not be up to standard, or there may be some lapses in that procedure. All these are operational risks. Then the model risk. So we use different, maybe it may be a business model. We use a business model. If that model is not good, that may give us a bad result. So that's a model risk. Not only that, when we discuss about this market risk, liquidity risk and credit risk, to measure those risks, we use different models. We are going to discuss about scenario analysis, stress testing, and things like that. To do that, we use models. If that model is not appropriate or it's not properly executed, then our outcome may be we may get wrong or false outcome. That is model risk. Then the settlement risk. Sometimes we consider it as part of credit risk. Sometimes we consider it a separate risk. Again, it can be settlement. We may not be able to make our settlement due to operational issues or due to liquidity problem. So the settlement is that we may not be able to settle on time. That's settlement risk. So sometimes we consider it as part of credit risk as well. So however, we are going to discuss this settlement risk more details under credit risk. Then the legal risk. We enter into, as financial institutions, we enter into a lot of legal contracts. It may be with individuals or maybe with other banks, other corporates, or maybe with service providers. So we have to make sure that all our risks are covered through these legal contracts. And as an institution, we have to make sure that we don't do any illegal activity. We are in compliance with all rules and regulations imposed by the central bank or maybe the general law of the country, things like that. So there's a risk. We may not follow the rules and procedures properly, or there may be some violation. So that there's a risk that we have to tackle. And taxes, time to time government change tax policies, procedures that will have an impact on our objectives. May lead to a financial loss. Even in legal, if somebody sue you and ultimately you have to make a compensation, that would become a financial loss. All these activities or all these risks maybe not necessarily end up with financial loss. Regulation, as I mentioned, regulations imposed by central bank or any other supervisory authority. The institution has to follow this regulation and be in compliance all the time. Be in compliance with this regulation. If you fail, you may have to face those repercussions. That is regulation. Then political environment globally, locally, both can change. That will arise risk to the institution. The last one, reputation. For a financial institution, especially a deposit taking institution, reputation is very important. I think everything depends on the reputation. The moment that you lose your reputation, that's the end of your business as a financial institution. So this is very important. Again, there's a debate whether the reputational risk, whether reputation, is it a risk or it's the outcome. Sometimes we can think it's as the outcome. Say in this operational activities, there was a fraud in your bank. What could be the outcome? It will have an impact on your reputation, your bank reputation. So nowadays, mostly reputation is considered as one of the outcome. So where we get the impact. It's like it may be a financial loss or it may be a reputational loss that can happen. So nowadays, mostly reputation is considered as a variable which have an impact of all these. Even a financial risk, financial loss will have a reputational. So these are the major types of risks which are known by now. But again, these classifications, now you may see different new terms. So I have not put any risks like cyber risk, things like that. Earlier it was considered as, because systems, failures in systems or things like that, considered as operational risk. But nowadays, cyber risk has become a very important one because there are a lot of cyber attacks and things like that. So therefore, the tendency is to consider it as a separate risk. So if you now look at a book or browse types of risk, in this risk there may be cyber risk or IT risk, something like that. So time to time these terms may change or these things may be break up into very small parts. One of these may become prominent. That can happen. So we never know what are the risks that we may face. These are the some identified risks, but there are risks that we have not seen yet, not only as banks or not only as Sri Lankans or maybe globally as well. So therefore, there can be a lot of unforeseen risks. It would be better if we can have some way of handling whatever those things, or at least keep some provisions if that happens, how to recover, especially as a financial institution. So we'll move into the next slide. So here we discuss different risks that we face by faced by financial institutions. In here we discuss about how to assess, how to evaluate. So that means we should be able to quantify the risk. We should be able to measure the risk and quantify it. Then it is easy for us to take actions. But the thing is, not all these risks can be easily quantified. Different risks have different characteristics, so therefore it's not easy to quantify. So if you go down this list, market risk, credit risk, liquidity risk, these are easy to quantify. There are ways, well-established procedures to quantify these risks. It may be because even in 1970s or 80s or even before that, they have identified these risks. Market variable changes, therefore there's a risk. The counterparty may default, so there's a risk. The borrower may not repay that, so there's a risk. And therefore people have studied how to measure these, what are the actions that we can, how to quantify these risks, even the liquidity risk. So that may be one reason that we have now very sophisticated methods to measure these risks. But operational risk, political risk, legal risk, regulation, and all other non-financial risks that we discussed earlier, most of these are very difficult to quantify. There are no ways of quantifying these variables. That itself gives us a risk. Without knowing what is the risk, it is difficult to take actions to mitigate or even to assess whether this risk is something that we can bear. So we have to lower that risk, mitigate or control that, put some controls on that risk. But again, with some events happened in the financial market globally, people realized that operational risk, especially in 2008-2009 crisis, when they dig down to find out what is the reason for this crisis, they found it's not market or credit risk, the cause, it is the operational risk. These operational risk events then triggered this market risk and credit liquidity risk. So they realized that there were loopholes in this, or not enough attention was given to operational risk. Now that's why with Basel III and onwards, more focus on this operational risk. Now, there are a lot of research going on how to quantify these operational risk, and they come up with different risk measures. However, in this course, in this module, we are not going to discuss more detail about these operational risk, political risk, and legal risk. We mostly focus on this market risk, credit risk, and liquidity risk, because those are the key that the Treasury has to focus on. But it doesn't mean that Treasury does not or should not worry about operational risk or the models that they use or the legal or regulation compliances, things like that. Any questions?
Okay, sir.
So if not, we'll move into the types of risk. The liquidity risk, one of the most important risks that we face by financial institutions. What is liquidity risk? I think you might have discussed in ALM session as well. What is liquidity? That is the ability to meet our financial obligations without any delay. As a financial institutions, what are the obligations? There may be borrowings maturing today. So the institution should be able to pay the lenders on time, principal amount and the whatever the interest that they have. Not only that, there may be a lot of utility bills, including salary, electricity bills, water bills, and for the other service providers, maybe security firms. There are many, and IT firms, those who provide service, courier service. There may be a lot of other operational activities, and the bank or the financial institution is supposed to pay that rent, maybe for the building, things like that. All those are financial obligations of the bank or the financial institution. Not only that, you may have grant loans. Once you grant the loan, when your borrower comes and asks for money, the bank should be able to give it. You have granted the loan, approved the loan, and inform the customer that, okay, your loan is approved, now you can take it, and you may credit that funds to a bank, your customer's account or some way. But whenever he comes actually to take that money, bank should be able to give it. That is also that is also making payments, or the allowing borrowers to borrow funds is also financial. Excuse.
Sorry.
There's a noise. Can you please mute your microphones? So whenever you want to ask a question or need clarification, then please switch on your microphone, otherwise please be muted all the time. Thanks. So what I was explained, the financial obligation, it's not only the borrowings or the payments that the bank or the financial institution to be made, but also the commitment the bank has made towards borrowers. The bank should be able to meet that requirement, borrower's requirement. So that is also part of liquidity. Not only that, oh yes, when we say that asset, it also measure of the bank's ability to fund any asset. That means to meet borrowers' requirements, because borrowers are assets. Not only those, but say if you want to, if the bank wants to make an investment in government security or equity or buy some commodity or a land or something like that, any other asset also covers under liquidity. Whether the bank has money, funds to meet all those requirements, that is liquidity. You may have lot of assets, very good quality assets, but you may be illiquid. If you cannot generate funds, cash, and meet the obligation, that means that you have liquidity problem. So liquidity risk, that is the probability of loss arising from a situation, as I explained earlier. All these situations I explained, I think. So basically, cash or cash equivalents to meet the needs and depositors and borrowers. So either we should have cash or cash equivalents. What does it mean by cash equivalents? Very liquid assets. Anytime you can liquidate it and generate cash, like treasury bonds, treasury bills, things like that. You can go to the market, sell that asset and generate cash. It doesn't matter that you bought a government bill paying 100 rupees, say 90 rupees. Now its value is only 85 rupees. You incur a loss, it doesn't matter. But still you can sell it and generate that 85 rupees. So that is liquid. Whether it generates a loss or a profit, it's a different story. But you have good quality asset which are almost equivalent to cash. If you don't have that, then it would become a problem. Then the other thing is, sale of illiquid assets will yield less than their fair value. So we may have a lot of illiquid assets like lands or buildings, something like that. But to generate funds, you may have to sell it very quickly. That means you may have to sell it below the market value or the fair value. That is also a problem. That when that happens, your liquid position, ability to generate liquidity, goes down. Or the third one is some illiquid asset you may not be able to sell at all. Whenever you need funds, you may not be able to sell that illiquid asset whenever you need funds. That may also gives a financial institution a liquidity risk. What would happen?
So what are the example of liquid assets?
Illiquid assets.
Yes.
So like in a bank, what is the most illiquid asset?
Liquid asset is cash.
No, illiquid assets. What are the most?
Mm.
What is the most illiquid asset in a bank?
Land and building.
Land and building? No, no. I think that it is illiquid. Yes, land and building it's illiquid because you cannot sell it very quickly. But there are some other assets which are not liquid at all. Can you sell your loan portfolio? It's very difficult. So almost
Yeah.
not possible unless there's a demand for a securitization process. Otherwise, it is very difficult. So your loan portfolio is also a illiquid asset. Then land and buildings may be if bank has any vehicles and things like even HR is we consider as asset. You cannot sell. So those are the example of illiquid assets. Clear? What are the liquid assets? Cash. Cash is the most liquid form. Then treasury in Sri Lankan context, treasury bills, treasury bonds, and repo transactions we can consider in a way that's liquid because those are maturing in very within very short period, and there's a possibility of if other party agrees to unwind the repo transaction premature. That possibility is there. So therefore, those are considered as liquid assets. Loan portfolio, buildings, land, those physical assets are considered as illiquid assets. So what would happen if a bank fails to meet liquidity? That is the end of the business. The bank needs money to cover all obligation on time. Whenever customer comes and asks money, if bank says, sorry, we don't have cash today, come tomorrow, we'll give you, what would happen? The next minute, there will be a lot of customers in front of bank branches asking their money back. Not only a depositor, even if you say that to a borrower, yes, we have granted the loan, but we don't have money today. Can you come later? Even he is a borrower, then there will be a problem. So bank should be liquid at all times. That means bank should be able to meet its obligations towards all these stakeholders. It may be a depositor, or maybe another bank, or maybe a borrower, or maybe to the government, like paying tax and things like that. Should be able to meet all these obligations on time. If you fail, first thing what would happen, depositors will lose their confidence. The bank is at a risk. The bank will lose the reputation. Then what would happen? They have become a bank run. That is the minimum. That is the minimum. Bank run is the minimum if you fail to meet your obligations or liquidity requirement. What's a bank run? That means all depositors will come and ask their money back at once. Now depositors comes and takes their money. Yes, everyday depositors will take their money. Yes, but meantime there will be new depositors, and even the depositors, they won't take all their funds. Not each and every depositor comes and asks for their whole deposit. But in a bank run, what would happen? Each and every depositor will come and ask for their money, the whole value. Is it possible for a bank to do that? No, it is impossible. The main characteristics is that this confidence. Depositors, they have the confidence on the bank that the bank will give my money back. That's why we place deposit with the bank. The moment that you lose that confidence, everybody will start to withdraw money. Any bank in the world cannot meet that requirement. Why? Not all deposits that you keep it in cash. You take 100 rupees, you set aside 2 rupees as reserves now based on the current requirement, and lend other 98 rupees to customers. So you have assets, you have liabilities, balance sheet is well balanced, but liquidity you don't have. That's the nature of a bank. You do transformation. So no bank in the world meet or pay back all depositors' money at once. It is not possible. So therefore, reputation is very important, and that reputation will there until depositors have the confidence in the bank. That depends on the liquidity level of the bank. So I mentioned, if a single bank fails to meet its obligation, the minimum impact is the bank run. That means that bank, that particular bank collapse. The good example is during 2008-2009 crisis is Northern Rock. It's a UK bank. Ultimately, government has to bail out. Why? Otherwise, this bank run, the failure of Northern Rock, could have an impact on other banks as well. Northern Rock, definitely, it had some obligation to other banks in UK. When Northern Rock fails, that means they cannot pay obligations to other banks. What would happen to other banks? They are expecting some cash inflow, fund inflow, they don't get it. Then what would happen? They also face liquidity. They may not be able to meet their obligations. So it's like you are expecting your salary on, say, 25th or 10th of each month. What would happen if you don't get that salary? Your bank is waiting to deduct your loan installment. You may supposed to pay other obligations, maybe school fees, maybe tuition fees, things like that. You may not be able to pay that. Likewise, even banks, they face the same thing because they are waiting other banks to pay their obligations to you. If you don't get that, you are in trouble. You may not be able to pay your obligations back to other banks and depositors. Then the confidence on that bank also vanishes. Likewise, this can happen, or this will trigger triple or ripple effects, trigger ripple effects. The loss of one confidence on one bank may trigger depositors confidence, loss of depositors concern about the whole financial system. The whole financial system may collapse. Up to some extent, that what happened in 2008 and 2009. Banks, they realize that there are some banks which are having some liquidity problems, but they don't know which bank. So what they did, they stopped lending each other. Barclays, they might have enough liquidity, more than enough excess cash. They would like to lend it, but they don't know. Say Citibank, they don't know whether Citibank is liquid enough. They don't know the position of Citibank or JP Morgan or HSBC, whatever the bank. So what? Those who have with enough liquidity, what they did, they just kept it with them or buy the government bonds or treasury bills instead of lending each other. Then that creates another problem in the market. The liquidity dries. So there were some banks with, yes, definitely on a particular day there may be a bank with shortage, liquidity shortage. What do? They borrow from another bank for a short period on which they have enough liquidity to pay it back. But what happened in 2008-2009 crisis? None of the bank lent each other. So even for a very short period, some banks couldn't meet their liquidity requirements. And the result was the collapse of individual banks. As a result, the whole financial system. So that can happen. So that is why the liquidity is very important for a bank. That's why regulators, they have put some controls, limits on this liquidity. Even this SRR, it can be considered as a rule of monetary policy, not only policy, just to control some liquidity as well. Yes, it's not enough, but you have some cushion. Not only that, that's why there are ratios like liquid asset ratios and things like that. The minimum requirement has imposed by regulators just to make sure that each and every bank is liquid, maintained well within limits without causing a problem to the system. The regulator's role is to make sure that the financial system is stable, not the individual banks. Yes, regulator monitors each and individual banks to make sure that the financial system is stable. If a failure of a one bank, that may trigger failures of other banks as well. So therefore, liquidity is very important for a bank. How do we manage liquidity? We can do it in different ways. We can manage liquidity through asset side or the liability side, or as a combination of this asset and liabilities. What does it mean by manage liquidity? with assets or asset side liquidity management. As I mentioned earlier, if you have liquid assets, that you can convert those assets to cash very easily, very quickly, without having impact to the market or to the fair value of the asset. So that is the liquidity management from asset side. That means the bank or the financial institution should maintain sufficient level of cash or assets that which can be easily converted to cash. That's why regulators also impose that liquid asset ratios and other liquidity coverage ratios. Other side is the liability side. If you can borrow from the market very quickly at a fair cost, then again you can meet your obligation. If you can borrow, you can use that borrowed funds to meet your obligation. That is meant by managing liquidity with liability side. But the thing is, to do this, you have to maintain your creditworthiness at a very good level. That means the lender should be able to trust you, that the lender will get that money back on time and the exact amount. If you have that creditworthiness, then you can borrow from the market. But if the participants in the interbank market or the lenders to the financial institution, if they lose their confidence about the bank or the financial institution, managing liquidity with liabilities would be a problem for the financial institution. Because if there's no lender, the financial institution may not be able to borrow funds at any cost. Say now the market interest rate is 4%, 5%. But if some bank thinks, say bank A is not that liquid, there's a problem with bank A, then bank A may not be able to borrow funds even at 20% or 50% overnight. The bank borrower should be able to maintain its creditworthiness. So the confidence among the market participants. So therefore, it's not, there's a cost even in manage the liquidity with asset sides or the liability side. What is the cost of managing liquidity with asset side? When you manage liquidity with asset side, what do? You maintain cash or more liquid assets. Cash, what is the return that you get? You don't get any return on cash. But most liquid asset, treasury bills, things like that, very short-term products, you get very low interest income. So you forego some interest income when you manage liquidity through asset side. What are the cost of managing liquidity through liability? You never know what would be the market interest rate whenever you want to borrow. You have to pay for that. Sometimes you may have to pay 2-3 basis points more to borrow depending on your requirement. So the borrowing cost is there. That is the cost of managing liquidity through liabilities. Not only that, there's a risk in this particular. You may not be able to generate funds at any cost. That is the risk of managing liquidity through liabilities. So therefore, I don't think any bank strictly follow or strictly use liquidity management on the asset side or the liability side. You can't do on the asset side. It may be a mix, both assets and liquidity, depending on the views and the requirements, size of your requirements or the size of your balance sheet. What is your call on the market? That means whether you think interest rate will increase or decrease. Considering all these factors, any bank may manage its liquidity partly through assets, partly through liability. It doesn't mean that that is 50-50. It may be 75-25 or something like that, or 25-75. That depends on the view on the market and the position of the bank and the business model. So this is how do we manage liquidity. How do we measure that risk? And what are the strategies that we can use? Is this gapping strategies. What is a gap? I think you have discussed gap, positive gap and negative gap. The gap is the difference between tenors of assets and liabilities. Or within a particular time bucket, whether you have more assets than more liabilities, or you have more liabilities than assets. If you have more liabilities than assets within a specific time bucket, time frame, then we have a negative gap. If you have more assets maturing within a specific time bucket, then we have a positive gap. Why? What does it mean by negative gap? You have more liabilities to be matured within a, say, within 1 day, but you have less liabilities, less assets maturing within a day. Then your inflows are not sufficient to meet your outflows, liabilities. There is a gap. You have to fund that gap somehow. That's why it is negative. Your outflows are more than the inflows. So that is a negative gap. You have to borrow. But in a positive gap, what would happen? You have more assets than the liabilities within that time frame. So you have enough cash to, or enough funds to meet the liabilities. And after meeting those liabilities, there will be excess funds. That is why we call it a positive gap. So this illustrates negative gaps. So assets, you have a 1 year asset at 30%, but you have a liability for a 6 month at 25%. That means you have borrowed funds for a 6 month period at 25% and generate an asset for a 1 year period at 30%. Is it good? Yes, because you have a 5% margin. Your interest income, net interest income is 5%. But what's the problem? Your liability matures in 6 month period. After 6 months, you should be able to pay this liability. But the borrower won't pay anything in 6 months. So this is a negative gap. After 6 months, you have to generate funds to fund this asset. Basically, you meet this liability means you fund this asset. To do that, after 6 months, you have to create another liability. So this is an example of negative gap. So what type of expectation that you might have when you have a negative gap. Why do you create a negative gap? This is the decision is to borrow 6 months and lend 1 year is your decision. It's not someone else's. Yes, customer may ask for a 1 year loan or 5 year loan, whether you grant that or not, it's your decision. And which sector that you encourage customers to borrow, that is your decision. You might have discussed about asset liability, ALCO, and maybe transfer pricing. That's how you encourage customers to borrow or lend at different tenors for different tenors. That is, so it's your strategy. In this, the bank has decided to borrow for a short period and invest for a long period. Why? You expect in 6 months time interest rates to go down. That is your expectation. When interest rate goes down, you can borrow at a cheaper rate, but still your asset will generate 30% interest rate at a, or the generate your income at a higher rate, while the borrowing cost is now low. The second half of the asset year, 1 year period, your interest income, net interest income increases. Only if your view is realized. That means your expectation was to interest rate to go down. If that happens, yes, you can borrow at a lower rate, your net interest income will increase. But what is the risk here? If the market interest rate goes up, that's the first thing. If market interest rate goes up, you have to borrow at a higher rate. So your net interest income may be less compared to the first 6 months, or it may be negative. But say, assuming this example, if interest rate goes to 32% or 35%, for the second 6 month period, you have to borrow it at higher rate than this 30%. So the net interest income negative. The bank incur a loss. That's the first thing. You face the market risk, interest rate risk. Not only that, after 6 months, you should be able to borrow. So the first thing is, at any cost, you should be able to borrow. If the confidence or your credit worthiness has decreased, people in the market, participants in the market are not willing to lend you, then that would become a major problem. You may not be able to meet your liquidity. So having a negative position is very risky, because you may not be able to borrow funds required at any cost. So the risks of negative gap, the first one is price risk. That means interest rate may increase instead of decrease. The second risk is the liquid risk. That means unable to get the funds at all, because in this strategy, you think, oh, your intention is to manage liquidity through liabilities, generate new liabilities to meet obligations. That is your intention, but it may not possible when it comes to that you need funds. So having a negative gap, you face two risks: price risk and liquidity risk, and it is too risky. So therefore, so this is the identification of risk. What is your strategy? What is your business model? What would be the risk? Okay. So now you have to decide whether be able to carry this risk. Definitely you want to do that you will generate new liabilities, small amounts, and spread those liabilities throughout this year. Not only that, you spread your assets also throughout the year. Then there are inflows and outflows. Match as many possible, and you have only very small gaps. So in summary, a negative gap involves both price risk and liquidity risk. What is a negative gap? Negative gap is where you have assets or longer maturity assets funded with short maturity liabilities. But that's the nature, more common nature of a bank, because deposits, saving, and other deposits are very short term, maybe maximum up to 1 year. But you have the possibility to roll over them, even though your balance sheet from liability side maybe 60-70% through savings. You know that not all those savings withdraw at a single point of time. They may spread, and maybe 60-70% of savings balances will remain there. There may be new deposits while some are withdrawing funds. So considering all those things, you have to create a gap report and see what is the gap. And if there's any negative gap, you should be identify, assess whether this gap is something that we can manage or it's beyond our control. Then you have to take some actions to bring that gap to a manageable level. So then the other gap is positive gap. Yes.
Now in a current scenario in Sri Lanka, whereas our interest rates are very low.
Yes.
In that scenario, like for banks, will it be ideal to maintain negative gap, or like what should be the way we need to look at?
Again, it's not only the current situation. Now you think the interest rates are very low.
Yes.
What do you think interest rate in 1 year's time?
Be remain as it is. So yeah.
Yes. That's the key.
That depends.
If you think this is the bottom and now and onwards interest rate will increase, what do? Create a negative gap or a positive gap? If interest rate to increase in future,
Positive gap.
you create a positive gap. Why? You create more longer liabilities and short-term assets. Then when assets are maturing, you can reinvest those funds at a higher rate, while your liabilities are maintained at the lower rate. But if you think there's a possibility that interest rate can go further down, then you may create a negative gap. That's why I said that depends on your view on the market. But the thing is, now when it comes to interest rate 4%, 2% or 4% at a historical low level, the maximum that can go down is theoretically it's 4%, go to 0. Then the chances and that possibility, and if it goes other way, what is the end? So that has to be factored into. Even you think the interest rate will go down further, it may be, you may think it's only another 1% or 0.5%. And what is the probability of that? And what is the probability of increase in interest rate by 1% or 0.5% or more than that. Considering all those things, you create the gap. It's not only whether it's a positive or negative, and what is the size of it. I think now the bank may either tend to create positive gap, or even they want to create negative gaps. It may be very small. They may not take large bets on that. That's my reading. I think
Okay.
that may be the
Yeah.
way that you should.
Yes. Now, sir, in order to us to get a view on how the market interest rate behave next 1 year or 2 year, like is there specific websites or is there specific institutions who calculate the forecasted interest rates to get an idea, like or the central bank does it
Central
or
bank does it. Definitely, central bank has an evaluation what would be the economy and economic conditions, government policies, and considering all those things, what would be the impact. But central bank cannot announce it. Once central bank announce it, that means it's given. So considering those factors, central bank may take actions at the right time. But I don't know in Sri Lanka whether there is any. Yes, there are a few market research firms, but they don't provide it for free. Definitely you have to pay to get that. And the other thing is whether somebody has done some back testing on their forecasting ability. I can say I can write a report with some graphs and some analysis and models. Okay, based on this, I expect interest rate to be 6% by the end of 2021. I can do a report, but there should be some credibility for that report as well. Otherwise, nobody would buy that forecast. So that has to be there. I don't think in Sri Lanka whether we have that quality forecast. There may be, but definitely you may not be able to just find it over a website. Even if they give, they may give a one or two sentence overall thing, but to get to know about the factors behind that forecast, you may have to pay for them. That's the other important thing. Say when you make a forecast, you use some model or forecasting model, and you make some assumption. And based on that assumption, okay, assume like now we have a import restriction. What is the reading of the market about this import restriction? How long would the government maintain this? One can do a research and come up with a interest rate forecast, assuming this import restriction will be there for another 1 year period. If it is there, import will be curtailed there, so therefore there won't be any pressure on the exchange rate, so therefore there won't be any pressure on the interest rate. Likewise, yes, there will be a forecast, but after 6 months, what would happen if the government lift that ban? Then your assumptions no longer valid. The picture completely change. So therefore, whenever you have some forecast, don't think about or take the final figure. Consider what are the assumptions, what are the assumptions, what is the model they have used, and validity of those assumptions. With that, only you can rely on that forecast. And during the period, if you see any of those assumptions are going to change, the validity is going to change, then your forecast has to be revised. So I think you cannot rely on just on the forecasted figure, but the factors behind that. You have to be in the market, read the developments, know the development, what is going on, things like that. And I think, not I think, it should be, the bank should have some unit to, or maybe treasury, or maybe separate unit to do research and study and come up with those forecasts. That has to be presented to ALCO to take decision. That has to be there. It may be internal team, or maybe outsourced one, and maybe a combination. You take outside reports as well as internal reports and make a judgment. That should be the way. Otherwise, there's no specific place that you can find forecast. But even in the international market, if you go to a service provider like Bloomberg, you can find forecast for each quarter, maybe for up to another 5 years. But forecasts are very wide. There are banks, some are expecting interest rate, say US dollar interest rate, to go down to even to a negative territory, and some expect that goes to 2-3% back again. And there are a lot of forecasts, different forecasts. So it may be a vast range. You cannot use it as it is. It's very difficult. So you have to do a study. As I mentioned, think about what are the assumptions, what are the models, whether these assumptions are valid, and things like that. That's the answer I can give to that question. There's no one forecast that you can rely on. Okay.
Thank you, sir.
Positive gap, as we mentioned, in a positive gap, we have short-term assets and funded with long-term liabilities. So then we don't have to worry about borrowing again, creating new liabilities, because assets are maturing before the liabilities. So as we can reinvest assets for the rest of the period. But what is the risk again, or what is the expectation on this? As we discussed now, we expect interest rate to increase. That's why we create short-term assets. When the assets are maturing, the interest rate has gone up, then you can reinvest that maturity proceed at a higher rate while you pay liabilities at a lower rate. Your net interest income increases. So that's the expectation of a positive gap. This illustrates that you initially invest at 30%. After 6 months, interest rate has gone up. Now you invest it at 40%, while your liabilities, the cost of these liabilities only 25%. So what is the risk? The price risk is there. Instead, interest rate going up, it can go down, maybe below the rate of liabilities. Either net interest income may be shrink or may go into negative territory. That risk is there. The price risk is there, but there's no liquidity risk in that gap for this strategy, because you have excess cash flows after 6 months. You can reinvest it. You don't find any difficulty of generating liquidity when you have a positive gap. So this slide summarize what we discussed so far about liquidity risk and gapping. So again, to summarize, negative gap, long-term assets funded with short-term liability, expectation of the interest rates to go down. The risks are price risk and liquidity. In a positive gap, short-term assets are funded with long-term liabilities. So therefore, we expect interest rate to go up in the future, and we face only the price risk. So we'll stop here, we'll take a break, and we'll come back and discuss market risk and the credit risk. If you have any questions before we stop, you can ask.
So how we can identify whether the institution is under a liquidity risk
Sorry?
or liquidity? How can we understand whether the institution is under a liquidity concern or the risk? Like,
So
what are the indications?
you mean your institution or some other outside?
No, generally, yes.
No.
The financial institutions.
That depends on the information that you have. So in your organization, if you know what are the maturities of and the amounts of liabilities and assets, you can create a gap report and see whether you have a negative gap or a positive gap. Basically, you do bucketing and put all assets, and you divide the whole time frame into different buckets. Say overnight bucket, 1 day to 1 week, 1 week to 2 weeks, or 2 weeks to 1 month, 1 month, 3 months, beyond 3 months, or somehow. Then you put all the assets into the corresponding bucket. Any asset maturing in 3 months, you put it into 3-month bucket. You know the amount.
Yes.
Likewise, you do that for all assets, financial assets, and all liabilities. Then you see the aggregate value of assets maturing in a particular bucket and aggregate value of liabilities. Then you can see what is the mismatch, whether there's a positive gap or a negative gap in that bucket. That's how you identify whether you have a negative gap or a positive gap, if you have that information. But definitely you may not get that information about a outside part, other institutions.
Yes.
Then you have to go to the market and see what sort of transactions that the other party has done, whether that party is borrowing from the cold money market or do repo transactions very frequently. If the party borrows every day from you substantial amount, what does it mean?
There's a liquidity problem.
They need liquidity. They have a negative position.
Negative.
So through that only you can come to know what is their strategy or the position. It may not be exactly the way. It may be wrong, but that will give you a good indication.
Thank you, sir.
Any other question? If not, we'll stop and we'll take a 15-minute break. So like now it's 10:33, is it correct? Yes. Shall we start 10:45? So any question? Then, so we discussed about liquidity risk, and I'm not going to discuss more than what we discussed about liquidity risk, because in the ALM also we have discussed about this liquidity and preparation of gap reports and all those things. Is it correct? So
Yes,
then
sir.
we'll move into the other major risk type of a financial institution, that's market risk. Again, today I'm going to give a brief introduction about market risk, and later we'll discuss in detail about market risk, especially interest rate foreign exchange risk, and what are the how can we use the derivative products to mitigate interest rate risk and foreign exchange risk. But I'll give you a brief introduction about market risk. As I explained earlier, market risk, it is the risk that a loss can arise from movements of market prices. When we say market prices, it can be any price of any asset or a liability. Basically, there are four major variables that leads to change in market prices, because most of the financial instruments, financial assets or financial liabilities are sensitive to interest rate. So therefore, market risk can arise. That means price of a financial asset can change due to a change in interest rate. So therefore, we call that the interest rate risk. Then the other variable is the foreign exchange. With the foreign exchange rate changes, value of assets or liabilities or the transactions may change. The financial institutions may incur a profit or loss with the change in foreign exchange rates. So the third one, there are banks or financial institutions which have exposure to or investments in stock market, equities, especially investment banks. So with that, when the stock prices, equity prices changes, then that will give rise to risk to the bank or the financial institution. So therefore, stock market or the stock price also lead to market risk. Then the commodity prices that have an impact on a financial or the financial institution, yes, on a financial institution in two ways. It may be a direct impact or maybe an indirect impact. But here mainly we focus about the direct impact, because financial institutions, they may have invested in commodities or commodity related instruments, maybe a derivative. So the underlying asset is a commodity. When the price of that commodity changes, value of the financial instrument may change. So that therefore that relates to market risk. On the other hand, there may be assets or assets which have exposure to commodity prices. Like if you have given a loan to another firm which depends on commodity, then there will be an indirect impact of the commodity prices to your balance sheet. Like say, if a bank has given a loan to a airline, airline depends on the price, fuel prices, jet fuel prices. So if the jet fuel price increase, that will have an impact on the operating cost of the airline. That will have an impact on the profitability or the income of that airline, which may affect the payment ability of the loan. So that can happen. That indirect link is also there. However, here we are mostly focused on the that part may be basically handled through the that sort of indirect exposures may be assessed through the credit risk when they monitor the borrowers. But however, that is due to market price changes. Here we are not going to touch that side, but whatever the direct impact that may have due to changes in commodity prices, we may discuss. Again, how can we use derivative products or other financial products to hedge the exposure to commodities? So the concepts, all those use of all those products to control the interest rate, foreign exchange, stock or commodity price risk would be the same most of the time. So we'll go through whatever the derivative products that we discussed and how can we use to mitigate the risk or manage the risk in future. First, we'll discuss briefly interest rate risk, foreign exchange. Sorry, I'm not going to discuss foreign exchange rate risk today. We'll discuss it in detail on another day, but briefly touch on other things. Interest rate risk, that is the risk, as I mentioned, faced by a financial institution due to changes in interest rates. Because whenever interest rate changes, that will have an impact on the profit or the loss or the value of assets of a liabilities of a financial institution. So in a financial institution, you may know there are two sets of books. One is banking book, the other one is the trading book. What is the banking book? Most all loans and advances, which the assets that are created not for trading purposes are in the banking book. Maybe mortgage, personal loans, maybe a loan to a corporate. All these are in the banking book. Trading book, those are the assets that you have purchased with the intention to do trading. That means buy and sell to make a profit. Basically, most of the assets created in the treasury are fall into the trading book. If you buy stocks with the intention to sell it when the prices are going up, that sort of transactions or the positions fall into the trading book. Other assets created by the bank, they fall into the banking book. So in the banking book, there are assets and liabilities. They face two types of interest rate risk: refinancing risk and reinvestment risk. What is the refinancing risk? If you have an asset, to fund that asset, you have to borrow funds. By the time that you borrow again, you don't know what would be the interest rate. Interest rate might have gone up. And your borrowing cost increased. That is the refinancing risk. On the other hand, there may be assets maturing and you have excess funds. You may have to reinvest that maturity proceeds. By the time that you are trying to reinvest, the interest rate might have gone down. So therefore, your reinvestment will generate a lower interest income than the previous asset. So that is we call reinvestment risk. So basically, if the interest rate goes up, we face the refinancing risk. If interest rate goes down, we face the reinvestment risk. But in a trading book, generally we do mark to market very frequently, most probably daily. So what does it mean by mark to market? We take the market price of each and every asset and revalue our holdings to the market price. Then we compare it with the previous day market price and today market price, whether we have gain or whether we have make a loss. That is we call mark to market, and it may be a mark to market profit or a loss. The loss is the risk, profit is the having a loss is the risk, making profit is the opportunity that we get due to the market risk. So therefore, for the banking book, also the trading book, we face the interest rate risk. All these changes when the market interest rate changes. So we'll discuss how to measure the impact of interest rate risk. There are basically two variables are considered: net interest income and the economic value of the portfolio. What is the net interest income? Net interest income is the interest earned minus the interest expenses. Whatever the interest income earned by the firm minus the interest expenses, because all financial assets will give you a interest income. Meantime, all financial liabilities will give you or will incur interest expenses. The difference is the net interest income. Remember, here you don't consider any other operational income or operational expenses. So any charges, fees paid or received are not included in the net interest income. Purely interest income and the interest expense. The difference between interest income and the interest expenses is the net interest income. Economic value of the portfolio is what is the real value of the portfolio. How do you measure? Even in the, say, if you can remember at the when we say when we discuss about fixed income securities, the price of a fixed income security changes when the interest rate changes. And mostly we will record a fixed income security in the trading book, because most of the banks, they buy as an investment, but they should be able to sell it at any time to generate cash. But a loan granted, it's not like that. If you grant a 1 million loan, it's 1 million in book, and the interest income will be recorded in the income statement. Balance sheet would show you 1 million as it is. Whatever the interest rate changes, that 1 million would be 1 million. But if you buy a 1 million face value bond, when the interest rate changes, value of that bond changes. When we do mark to market, we change it. We record that change and incur a profit or a loss. But in the banking book, we don't do that. But the thing is, assume you lend up 1 million at 10% for a 5-year period, but after 1-year period, 4-year interest rate is 12%. You have a opportunity loss. The 1 million that you have lent at 10% would have earned another extra 2% if we invested initially only for a 1 year and reinvest it at 12%. So that won't reflect in the balance sheet, that opportunity cost. But this economic value of the portfolio, even the assets in the banking book are revalued based on the market interest rates. So the economic value of the portfolio or the banking book will change. So we calculate the economic value of the portfolio to measure the impact of the interest rate risk. So to do that, again, we do gap analysis and duration analysis. Here the gap is slightly different from the previous gap, but we discussed earlier. Whatever the financial asset and financial liabilities we considered, but here we consider only rate sensitive assets and rate sensitive liabilities. That means what are the assets, the value or the income will change due to a change in interest rate. Whatever the liability, the value or the expense will change due to change in interest rate. So RSA is the rate sensitive assets, RSL is rate sensitive liabilities. The difference is the gap. Again, we say we have a positive gap when rate sensitive assets exceed the rate sensitive liabilities, or we call it asset sensitive. When there's a positive gap, our balance sheet or our balance sheet is sensitive to the changes in asset value. When we have a negative gap, it's other way around. That means rate sensitive liabilities are more than the rate sensitive assets. Then our balance sheet is sensitive to the liabilities, not to the assets. So when we then negative gap, we call liability sensitive gap. So again, this is sort of summary. Positive gap, we call it asset sensitive. So in that, assets are repriced before liabilities, as in the previous positive gap, because assets are maturing before the liabilities. Then the reinvestment is at a new interest rates. That's why we call it asset repricing before liabilities. So therefore, the net interest income will depend on the reprice of the asset, not the repricing of the liability. So this will have an impact on the interest income. Whereas the negative gap or the liability sensitive, the liabilities are roll over frequently than assets. Then liabilities are repriced at the new interest rates. Then the cost will increase or decrease depending on the interest rate movement. But the asset income will remain the same. So again, this will have an impact on the interest expense, and ultimately have an impact on the both will have impact on the net interest income. In a positive gap, the position is short-term assets are funded with long-term liabilities. Like in the previous gap. In the short or the negative gap, long-term assets funded with short-term liabilities. So liabilities are maturing more frequently than the assets. So then what is the impact of interest rate change? When you have positive gap, that means our assets are repricing very frequently. What would happen if interest rate increases? If interest rate increases, maturity proceeds, we can invest it at a higher rate than the previous period. So therefore, when the in an interest rate increasing environment, having a positive gap will increase the NII, net interest income. But other way around would happen if the interest rate decline. Assume we have loan granted at 10% and matures today. Now what would happen? Now we have to generate another asset maybe at 8%. Previously we earned 10% interest, now we earn only 8% on the same amount. So our interest income decline, therefore net interest income also decline, unless there's a possibility that we can reduce the interest income on the liabilities. But here we just assume liability expense remains constant, but the interest income changes. Especially when you have a positive gap, that is what happening. Assets are repricing more frequently than prior to liability repricing. So therefore, in an interest rate increase environment, net interest income increase. In an interest rate declining environment, when we have a positive gap, net interest income also goes down. When we have a negative gap, the impact is other way around. Reverse is true. That means when the interest rate increases, net interest income decreases. Why? Our liabilities are repricing very frequently. Therefore, our interest expenses increase with interest rate increase. But when interest rates going down, our liabilities are at a lower cost. Therefore, our interest expense goes down, and with that, net interest income goes up. So you should have proper idea what is a positive gap, what is a negative gap, what is the position that you have when you have a positive gap, and what is the impact of interest rate change when the interest rate increasing and when the interest rate decreasing, when we have a positive gap or a negative gap. So we'll do a small example, income gap analysis. So this is a sample balance sheet, shows assets and liabilities. So we consider just a one year period. What would be the impact on the interest income during a 1 year period? What we need, first we have to find out what are the rate sensitive assets and the volumes, and what are the rate sensitive liabilities and volumes. So if you go back to the balance sheet, the given balance sheet, you can see there are securities maturing less than 1 year. So therefore that means within a 1 year period, there are securities maturing, then we have to reinvest it at the new interest rate. So therefore, less than 1 year securities are rate sensitive and will be considered in this analysis. But the second item, 1 to 2 years, that means these securities are maturing after 2 years. But here we are going to assess the impact of change in interest income within a 1 year period. Even the interest rate changes within a 1 year period, the securities maturing in 1 to 2 year period won't get any impact. There will be any impact only after 1 year period, during the 1 year and 2 year period. But here we are going to assess the change in interest income within a year. So therefore, any of these won't consider. But in the residential mortgages, there are variable rate mortgages. These are considered because variable rates mortgages mostly assume we change the interest rate within a period of less than 1 year. So, and there are other mortgages at a fixed rate for 30 years at the beginning, but there won't be any impact on those mortgages. And there are commercial loans less than 1 year. That means those loans will be mature within a 1 year period. Then again, you have to reinvest. So therefore, there are 3 rate sensitive assets in this balance sheet which are maturing within 1 year period. So therefore, 6 million six, I think. I think something wrong in this, either this one or this one. There won't be any 36 million. This should be 6 million. And see, it's only 20% of the residential mortgages. Sorry, this 36 million is the total. Yes, 18, 12, 6, 36 million altogether. There are rate sensitive assets, but plus on these residential mortgages, there's a tendency that people may prepay the capital. There's a possibility. So what the bank has done, they assume 20% of residential mortgages prepay within a 1 year period. So that comes to 20% of this 12 up to 2.4 million altogether. Therefore, rate sensitive assets are 38.4 million. This is the total of these 3, 6, 12, 18, 18, 18, 36. Then 20% of residential mortgages. That is based on the estimate that you have in the, based on the previous experience or depending on the other factors based on your forecast. Because when the interest, nowadays you might have experience that since the interest rates are very low, people tend to settle the existing loan and go for new loans if possible. Whenever possible, they try to do that because they can save their interest expenses. That can happen when the interest rates are going down. Considering all those facts, this bank has decided or estimate that 20% of the residential mortgages will be repaid. So 20% of 12 million is 2.4 million. So at that you get 38.4 million altogether rate sensitive assets. So then rate sensitive liabilities, again, since we are considering only a 1 year period, we have to consider liabilities which are maturing within a 1 year period. So there are money market deposits, money market itself. So you know that these are less than 1 year. Then certificate of deposits which are at variable rate and less than 1 year. Federal funds, that means this is like funds that you have placed with central bank, less than 1 year other borrowings, sorry, federal funds, this is a liability that you have borrowed from other banks, other borrowings less than 1 year, 12 million. So altogether 18, 36, 48, 54. So 54 million liabilities which are maturing less than 1 year. Anything else that we have to consider? One thing is saving deposits and other checkable deposits, because these are, we never know whenever they or the depositors take that money out. Again, they have, this bank has done an assessment. They think 10% of checkable deposits like current accounts, they may take out those funds, and savings 20%. So 10% of this 18, 1.8 million, 20% of this 18, altogether 59.4 million rate sensitive liabilities. So then what is the gap? Rate sensitive asset minus rate sensitive liabilities, you would get a negative figure. You have a negative gap. What does it mean? If you have a $21 million negative gap, you have to borrow 21 million within 1 year period. Wow. You remember we started this with considering a 1 year period. So within a 1 year period, we have more liabilities than assets maturing within 1 year. So therefore, to meet this extra liabilities that we have to borrow. How much? We have to borrow 21 million. Okay, so we are talking about the next 1 year period start from today. What would happen if interest rate increased by 1% today? You have to pay 1% extra on these borrowings, only on this 21 million. So therefore, our interest income will go down because this is an expense. When we have a negative gap, our interest expense will increase if interest rate increase by 1%. So 0.21 million extra interest expense has to be incurred by the bank. So interest income, change in interest income or the net interest income is negative 0.21 million. Our net interest income will decrease by 0.21 million if the interest rate increase by 1%. Is it clear? So first you have to consider the assets and rate sensitive assets and liabilities maturing within the time bucket that we consider, and any other possible inflows or outflows based on the nature of these products that we have to consider. Then calculate the gap, then make the assessment. If interest rate increased by 1%, what would be the impact on the net interest income? Here, if interest rate increased by 1%, the bank has to incur 0.21 million extra cost. Now you have to decide whether this is bearable or not. If this is okay, you may keep the positions as it is. If you think this is too much, something that we cannot bear, then you have to take immediate actions to change the gap or the composition of the balance sheet. So this is the general equation This is the left hand side is the change in interest income. Indeed, it's the change in net interest income. It is equal to the gap into change in interest rate. So here, this is the gap. Gap is minus 21. 1% is the change in interest. So the result is the change in interest income. So this is the summary for a positive gap or a negative gap. If interest rate increase, decrease, what would happen? What would be the impact on the net interest income? So what is this arrow? It's increase. That means net interest income increase if the bank has a positive gap and the interest rate increases. Bank has a positive gap and interest rate increases. The impact on the net interest income is net interest income increases. Why? Positive gap means we have more assets than the liabilities maturing in that time frame. So assets will be repriced more frequently. When assets are repriced more frequently, while interest rate increases, new assets will generate higher interest income. Therefore, interest income increases. But opposite is true when the interest rates going down. When interest rate decreases, new assets will be reinvested at a lower rate. Then they will generate lower interest income. That will have negative impact on the net interest income. The opposite. So this increase. The opposite is true for a negative gap. When you are having a negative gap and interest rate increase, cost of borrowing increases, then net interest income decreases. You have a negative gap, interest rates decreases, cost of borrowing decreases, therefore net interest income increases. This is the summary. So you should be clear about this. Positive gap, negative gap, interest rate increase and decrease, and the impact on the net interest. So here we consider an example about how do we use maturity bucket approach to assess the net impact on the net interest income. So here in the previous example, we considered only 1 year, 0 to 1 year time period. Here we have divided the assets and liabilities into 4 time buckets. One is 0 to 3 months, the other one is 4 to 6 months, 7 to 12 months, and over 1 year. So there have been 100 million assets maturing between 0 to 3 months and liabilities of 200. So therefore the gap is 100. Likewise, for each time bucket, value of assets are given, value of liabilities are given. Assume in this balance sheet we have only rate sensitive assets and rate sensitive liabilities. So therefore totals are matched. The balance sheet is balanced. Then the gap for each period. First 3 buckets, the gaps are negative, but the last bucket, the gap is positive. So that has to be the case, because otherwise there will be a net gap somewhere. So when you do the cumulative gap, at the end it should be 0. What is the cumulative gap? That is, say, this is the gap for 0 to 3 months. This is the gap for 4 to 6 months. If we consider what is the gap 0 to 6 months, whole period, that is the cumulative gap. So it is the addition of the previous cumulative gap and the relevant bucket gap. So cumulative gap at the 4 to 6 month period is the cumulative gap at the 0 to 3 months bucket, and the gap in the 4 to 6 months. 100 plus 50, 150, 150 plus 200, 350. So all these are negative. So 350 plus 350, 0. So when it comes to the over 1 year bucket, no cumulative gap is there. It's 0. And the other thing is, most of the time banks, they have some limitations to control the risk. You don't take infinite risk. So having a negative gap or a positive gap, if your view is incorrect, you will incur a huge loss. So therefore, control that. There are limits. Most of the times, the limit is imposed as a gap as a percentage of total assets. So therefore, in each bucket, we have calculated cumulative gap as a percentage of assets. So the in the first bucket, cumulative gap is minus 100. The total asset is 1000. So therefore, the cumulative gap in the first bucket is minus 10%. In the second bucket, cumulative gap is 150 negative. As a percentage of total assets, it is 15%. But in the third bucket, that percentage is minus 35%. So the institution's gap limits are 3-month cumulative gap should be plus or minus 5%. 1 year cumulative gap should be plus or minus 20%. Now you can see there are clear violations because 3-month gap is minus 10%, exceeding the limit minus 5%. In the 1 year gap, cumulative gap, it is 35%, whereas the limit is plus or minus 20%. What are the ways that you can do to correct this? What are the ways that you can do to correct this?
You can increase your assets.
Yes, both are having negative gaps. So therefore, you have to increase assets in 0 to 3 months, and to increase the cumulative gap here, you can increase asset anywhere up to 1 year. So how do you do that? Either you can create new assets. That means you invest in, you grant new loans or something like that. But to do that, you need funds. Then you have to create more liabilities. That means you can expand the balance sheet. Instead of 1000, you can make it 1500. Both assets and liabilities, but put assets into different buckets, liabilities into different buckets. So we have to reduce this by 5%. That means we need at least another 50 million. If we can increase this to 150, then this will go to 1050. If that goes to 1050, we have to increase this to 1050. So we can increase 50 million assets here, but we cannot increase liabilities here. Why? Then there won't be any change. While increasing assets in the 0 to 3 months bucket, the best place to create the liabilities in the over 1 year bucket. So then that will balance. That is one way, creating more assets and more liabilities, but in different buckets, while bringing down the gap to the limit. Or other way is restructure the existing balance sheet, but practically this would be very difficult. Now there are assets mature, 550 million assets maturing in over 1 year. If possible, if you can switch these assets into this, you can do that. Say, assume there are government bonds that you have invested with maturities of more than 1 year. What you can do, you can sell part of that government bonds and buy 0 to 3 months treasury bills. That can be done. So restructure in the balance sheet. But remember, when you sell long-term assets and invest in short-term assets, there will be a impact on the interest income, because long-term maturities will give you high interest rate, whereas the short-term maturities will give you a low interest income. That can happen. So the best thing is, whenever you create new assets and liabilities, make sure that by the time that you create those, if you include new asset, any of these limit violation would not happen. Make sure that. Okay, what do? You want to create more assets and more liabilities, but you need more assets less than 1 year sector, more liabilities in over 1 year sector. How do you do that? How do you implement? Now you want to encourage customers to borrow for short period, but place deposit for a longer period. How do you do that? You want to encourage customers to borrow for a shorter period and deposit for a longer period. What do you do? In your interest rate structure, you reduce the lending rates in the 0 to 1 year sector. You reduce the interest rate in lending rates in the 0 to 1 year structure compared to the market rates. If the market rates, say 6-month borrowing is 5%, you may offer 4.9%. Then customers will come to you and borrow it at 4.9%. Meantime, you want to discourage customers to place deposit or the borrow from you for a period of more than 1 year. What do? You increase the interest rate, lending rate for that longer tenors. Then customers won't come to you and borrow for a longer period. The same strategy can be applied to generate liabilities in the long end and discourage any liabilities in the short end. Considering this only, ALCO decide what would be the interest rates applicable for each deposits and each product, basically each product, whether it's a lending product or a borrowing product. You encourage or discourage customers to take or create assets or liabilities depending on your view and your position. Not only view, that depends on your position as well. So now if you see a particular bank got high interest rates or offer high interest rate for deposit, what is your reading? When most of the banks take deposit at 4%, if another bank takes deposit at 4.5, how do you read about that bank? Either they are having a shortage, that means they need funds in the short end, or they expect interest rate to increase in the future. So just looking at the actions of other banks, you can think about or have some guess about their position and their needs. So that is about interest rate risk management, about the income side. Now we'll move into the duration gap analysis. This is another way of doing it. I suppose that you can remember what is the duration. How do you interpret the modified duration? Modified duration is the percentage change of the value of a fixed income security or a portfolio for a change in interest by 1%. So this is the definition. Percentage change in the price for a given change in interest rate. You can remember in the modified duration, we change it by 1 plus R. So this is the definition. So this is the general definition. But we can apply that general definition for all assets in our book. So DA reflects the duration of assets. Likewise, we can calculate duration of liabilities. Even liabilities interest rate sensitive. When the interest rate changes, value of your liabilities will change. So we can find the duration of assets as well as duration of liabilities. So we are going to use that to measure the duration of equity. When the interest rate changes, what would be the change in your equity? What is your equity? That is the difference between assets and liabilities. If there's any difference between assets and liabilities, that difference is the equity that shareholder wants. So if you remember the fundamental equation of accounting, assets equals liabilities plus equity. If we consider real liabilities and equities separately, or you can say, generally we say asset equals liabilities, but when we say liabilities, in that liability which includes the capital, that is equity part. What is the owner's holding? That is equity. So assets equals liabilities to other parties and liabilities to the owners, that is equity. So if the assets equals liabilities and equities, whatever the change in asset value should be equal to the whatever the change in value of liability and whatever the change in equity. Otherwise, this won't hold. So whatever the change in asset value is equal to the change in liability value and plus change in equity value. So from this equation, we can get an equation for the change in equity value as the difference between change in asset value and the change in liability value. So remember this. Change in equity equals change in asset minus change in liabilities. And if we go to this equation, duration equation, change in asset value is equal to the asset value into duration of assets and to the change in interest rates. Similarly, for liabilities also we can derive an equation. Change in liability equals amount of liability into duration into change in interest rates. Now we can substitute these two into this equation. Then we get this. This is the change in asset value. This is the change in liability value. So this change in interest rate is common for both terms. So we take it out. Then duration of assets into asset value plus duration of liability into liability. It's common. We can take out a negative sign again. Then the difference between change in asset, change in liabilities into the change in interest rates. That is the change in equity. So now we can incorporate the leverage. What is leverage? That is the liability over assets. So we can rearrange this equation, change in equity value, by substituting this liabilities with A into A and take out the K. So this is K is the leverage ratio. This equation gives you the change in equity for a given change in interest rate when you know the duration of assets, duration of liabilities, and the amount of assets that you have. So this is an example. How do we use this equation? Assume we have assets with a duration of 5 years. All assets, all rate sensitive assets, duration is 5 years. You know how to calculate the duration of a portfolio. That is the weighted average of the duration of individual assets. We can do the same thing to calculate the duration of the liabilities. So the duration of asset is 5 years, duration of liabilities is 3 years. So the current interest rate is 10% and we expect it to go in up to 11%. So interest rate are expected to rise from 10% to 11%. So what is the interest rate change that we expect? It is 1%. So this is the balance sheet in summary. We don't want the exact figures. We can assume it like this. Because, sorry, this is the balance sheet given. There are assets of 100 and liabilities of 90, then the equity is 10. This information is given. Then what is the leverage? 90 over 100. Liabilities over assets. So the leverage ratio is 0.9. If you go back to this equation, A, what is the size of assets? 100. Duration of asset 5. K, leverage ratio is 0.9. Duration of liability is 3. Change in interest rate is 1%. 1 plus current interest rate is 10%. So we substitute all these figures here. We get this. Remember to substitute these in decimal figures. So the change in equity is 2.09 million. So what does it mean? You have this balance sheet with these characteristics of assets and liabilities. You have 100 million worth of assets with a duration of 5 years. You have 90 million of liabilities with a duration of 3 years. You have only 10 million equity. What would be the impact of your equity value if interest rate increased by 1%? What would happen if interest rate increases? Value of assets will go down, value of liabilities also goes down, but duration of assets is higher than the duration of liabilities. Not only that, value of assets also high. So the reduction in the value of assets is much more than the reduction of liabilities. So therefore the impact is negative. So your equity value will go down by 2.09 million. So now you have 10 million equity. If the interest rate increase by 1%, your equity value will go down to 7.91 million, from 10 million to 7.91. So this is the impact on equity. Remember, I mentioned at the very beginning of today, the main objective is bank in this business is to create value for the shareholder. So what has happened here, shareholders value has decreased. So that's the risk. So you should have an assessment what would be the risk to the shareholders value, whether it's acceptable or not. If this gives you a more than 10 million figure, what does it mean? If the loss or the change in equity value is less than 10 million, minus 12 million, what does it mean? If interest rate increase by 1%, you have negative equity. That means you cannot run the business. You are insolvent. You cannot survive. So you have to take action immediate. Need immediate action to correct your position. So that's about how do we use duration gap analysis. Duration as a measure of interest rate risk, and how do we measure? Basically, using duration gap analysis, we calculate the impact on the equity value if interest rate changes. Any question? I'm going to move into the next.
So that means when we divided like 10 million is our equity value, if we divided 10 million on 2.09, that means it's close to 5%. If the interest rate goes increased by 5%,
Yeah, 1%.
that could lead.
If interest rate goes by 1%, yes, so your equity value decreased by 5%.
Okay.
Yes, you are correct. Because 2.09 million out of 10 million means 5%. Say this is 2 million out of 10 million is 1/5. Is it 5? It's 20%. No? Because sorry, 100, not 10. No, equity is 10. Yes, equity value is 10 million. Value of equity is 10 million. So 2 over 10 is it's
that means if interest go increase up on 4%, like 10 to 14%, that will be more than 4% in the sense it will lead to income.
Yes, your equity value will wipe out. That means equity value becomes negative. That means you cannot survive. Yes, that's true. Yes. But remember, the duration is valid only for a small interest rate changes. If you apply this for a 4% change, it won't give you a much better idea, because when interest rate increases, duration decreases, then the sensitivity would be less. Yes, but still there will be a substantial erosion of the equity value. Any other question? So the other one is the foreign exchange risk. We have a separate presentation on this FX risk. I think there are two presentations on the foreign exchange. We need 2 sessions indeed. Foreign exchange rate risk. First to discuss what are the foreign exchange type of foreign exchange risk and how to identify, and then the second one is how to mitigate foreign exchange risk using derivative. The next one is the equity risk and the commodity risk. I'm not going to discuss in details because this is not that much relevant for us. And we didn't discuss about equity, and it's out of this out of scope of this module. Otherwise, just what you have to know is what is equity risk. That is because of changes in equity prices, the value of your portfolio will change. You may incur a loss or a profit depending on your equity investment. So that is equity risk. So to measure that, there is a risk measure called beta. So we have to discuss all those things, but for this course, I don't think it is that much relevant. And the commodity risk, again, as I mentioned, when there are investments related to commodities, when the commodity price changes, value of your balance sheet or the income get affected. That is the commodity risk. I'm not going to specifically discuss how can we mitigate the risk, commodity risk using derivative transactions, but once we discuss how we can use derivative products to mitigate the foreign exchange risk, the same concept that you can use to mitigate the commodity risk. Only thing is, the difference is the underlying variable. That means instead of a foreign exchange rate as the underlying variable, in a commodity, you consider a price of a commodity as the underlying. So we discuss here market risk as different market risk with regard to different variables. Market risk we divide into interest rate risk, foreign exchange rate risk, commodity risk, and equity risk. But when you take a portfolio, depending on your investment, say you have loans given, you have government bonds, not only and you have borrowings and lending in foreign currencies, not only in local currencies, and you have invested in equity prices, equities, shares, and you have commodity investments, everything. So if we consider only the interest rate risk duration, that gives you only the changes in value of your portfolio or the equity value just because of the changes in interest rate. If you consider the exchange rate risk component, that will give you only the interest rate risk. If you consider the commodity prices and things, that will give you only the risk arising due to changes in commodity prices or the equity prices. But as a whole, the whole portfolio is subject to all those risks. While interest rate changes, the exchange rate also changes. That will have an impact on the commodity prices and the share prices and all those things. So in aggregate, what would be the change in market value, or what would be the value of the risk to the whole portfolio? How do we measure? That's why I put it here as a common market risk. So these are some of the ways of measuring market risk as a whole in aggregate, instead of looking at interest rate separate, exchange rates separately, and commodity risk and equity risk separately. When you put them all together, what is the risk? Okay. Think about if exchange rate rupee depreciate, what would happen to the interest rate in Sri Lanka? What would happen to the commodity prices in Sri Lanka? There's a correlation. If interest rate depreciate, that means maybe our interest rates are very low. That's why there may not be foreign inflows. Our interest rate low, therefore there's no foreign inflows. So exchange rate depreciate. So there can be impact. The impact of interest rate may negate the impact of exchange rate. There can be negative impact for the two opposite directions, impact in two opposite directions. When we take two variables, when we take three variables or four variables together, we don't know what would be the net impact. So that's why we need correlation between changes in interest rate. What would be the, if interest rate change by 1%, what would be the impact on the exchange rate, what would be the impact on commodity prices and equity share prices, and the net impact. How do we measure that? What would be the net impact on our portfolio? By how much value of our portfolio will decrease within a given time frame due to all these market factors. One thing is to measure that is the volatility. So, and the other thing is the most common risk measure is value at risk. Value at risk is, it is calculated based on the volatility. Value at risk gives you a single figure about a loss that you can incur given a given time period with a given confidence level. So I'll explain what is value at risk. Volatility is how volatile your return. Based on that only value at risk is calculated. Value at risk was very famous before 2009, 2008, 2009 crisis, but after that people realize even this is not adequate figure. Then they have come up with another figure called expected shortfall. So we'll discuss, I'll explain that everything very briefly. You need not to know exact way of calculating value at risk for the expected shortfall, but have some idea how to interpret value at risk figure and how to interpret expected shortfall. I'll explain that. The first thing is volatility. We'll start with volatility. So I'm going to use the board. Now you can see the board.
Yes.
Yes. Okay. Assume we have 5 assets. We have 5 assets during a 1 year period. During a 1 year period, these 5 assets generate say 10%, 11%, 12%, 13%, 8%. Sorry, consider for the time being, consider single asset 1 year return over 5 year period. So if this is 2019, this is 2018, this is 2017, 2016 and 2015. During last 5 years, this whatever the asset has given these returns. Do you know about what is the average return of these? It is just the sum of these figures and divide by 5. This is the simple average. 10%, 11%, 12%, 13%, 8% divided by 5. That is the average return. So then, have you ever heard something called variance or the standard deviation? Have you heard about variance and standard deviation? Variance measures, oh sorry, not easy to explain. Standard deviation is the square root of variance. So this measures, standard deviation measures the deviation of this from this mean, the return deviation from this mean, how far that return can deviate from the mean return. That is the measure of spread. 10, 21, 21, 33, 46, 54. 54 divided by 5. What is our average return? 10.8. Average return is 10.8. Average return is 10.8%. When we calculate the variance or the standard deviation, it will give you what is the possibility with some probability that return can deviate from this 10.8. If the standard deviation 2%, that means the next year return can deviate from 10.8 to 12.8 and 8.8 with this range with a approximately 65% or 68% chance. That is the measure of this standard deviation. How far you can deviate from your mean value. That is the measure of standard deviation. So standard deviation in financial terms, we call it the volatility. The standard deviation measures the, in financial terms, we call it volatility. If the volatility high, what does it mean? Your return can deviate far away from your mean return. So it is risky because you expect generally to get some return around 10%, but the volatility is say 5%, it can go down to 5% or it can go up to 15%. You don't mind about going up to 15%, but you worry about it is going down to 5%. So we can calculate this volatility based on the historical return. The historical return, that would depend all these variables, whatever the interest rate change, exchange rate change, everything is impacted on the return calculation of the asset. So everything is accounted for and the volatility measures the risk. Then the value, so in the value at risk, we assume, because return is a random variable, return can vary time to time. So it can spread over the range, and we assume the returns are distributed in a shape like that. If you have discussed anything about statistical concept, you might have heard about a normal distribution. We assume, in this case, we assume returns are distributed like this, whereas this peak figure is the average. This is our average return. This is our average return. Most of the time we get that return. But there can be instances our return falls below average or maybe above average. How far we can go, this is measured by the standard deviation. So in a normal distribution, approximately about 66.5%, we assume return figures are remain between one standard deviation figures. But in the value at risk, what we measure, we calculate the, say we need the confidence level. There's something called confidence level. That means how confidence about our estimate. If the confidence level is 95%, that means we consider 5% at the lowest. What is the lowest 5% return that we get? Say out of 100 return figures, what are the lowest 5% figure? Whatever that is, we call the VAR. This is the value at risk figure at 95% confidence level. Assume we calculate this risk annual basis, then this is within a 1 year period, we have a 95% confidence level that our loss would not be more than this VAR figure. Assume this is 2%, the average was 10%, this is 2%. So when we say value at risk is 2% for a 1 year period at 95% confidence level, that means within a 1 year period, we have a 95% confidence that we may not incur a return below 2%. So you can, if this is minus 2%, what does it mean? Our loss may not be more than 2%. Our loss may not be more than 2% with a 95% confidence. But there's another 5% chance that the loss may be more than 2%. Remember that. This VAR figure gives you a maximum loss that could incur within a confidence level, whatever confidence level that you use. Generally, confidence level used is 95%, but in some instance, 99% also used. Whatever the confidence level, that is the maximum loss. The VAR is the maximum loss that could incur within a given time frame and with the given confidence level. But there's a remaining or the another very small chance that loss may go beyond that. The expected shortfall measures what if we falls into this extreme case, what would be the average loss, which is measured through expected shortfall. I think for you at this instant, that at this level, you just know that there are measures like this, and I don't expect you to calculate this value at risk or the volatility at this level, because to calculate this and even to interpret this, you need some background knowledge on some statistical concepts and things like that. But value at risk, to understand easily, now you can see this can you see the Excel sheet?
Yes, sir.
So what I did, just created 100 random numbers. Assume these are this is year 1, or no, day 1. Assume daily returns, day 1, day 2, likewise. Returns of our portfolio for the last 100 days. We have returns for the last 100 days. What we can do, we can sort this. I'll copy this. Based on the values. Now I have all the previous values. Forget about now these values because it's refreshed and came up with new numbers. These are the values. So first day return is 43%, second day return is 19%, likewise. So we have return figures for 100 days. Now what we can do, we can sort it from the in the ascending order, smallest to largest. So the out of that 100, the smallest return is 0.9%. Can you see? 0.009 means 0.9%, and this is 1.44%. This is 4%, 5%, likewise. So if I to calculate the 95% in 95% significance level value at risk, what do you have to do? I have to omit the smallest 5 numbers. So what are those? 1, 2, 3, 4, 5. Then the next one is 6.33. So based on our historical data, we have that confidence 95% of the time we get a return more than 6.33. We get a return more than 6.33. That is value at risk. But there is a chance that there's a 5% chance the return will be less than this 6.3. This is this method called calculation of historical VaR. That means based on the historical return, we calculate the value at risk. So it need not necessarily to be 100 days or 100 weeks or 100 years. You can take whatever, but if you take 200 days, you have to omit 10 observations from here to get the 95% confidence level. If you want 99% confidence level, you omit only the last one. Then 99. This is the 91% confidence level figure. This is the 99% confidence level figure. 1.2. 90%. If you need 90%, you have to omit 10 variables and get the level. So basically, how do you interpret? This is the minimum return that you get with the 95% confidence level. Minimum 1 day return, because I mentioned that these are daily returns. If I take daily returns, this is the minimum daily return that I can expect with a 95% confidence. If this is monthly return, this is the minimum return that I can expect within a month at 95% confidence level. When you calculate these returns, you don't only consider interest rate, only the FX risk. No, not like that. You consider all risk at once, all variables, and whatever the interaction of this risk will be reflected. So that's why this value at risk was accepted by market participants as a very good measure of aggregate market risk. It gives single figure, shows you what would be the maximum loss that you can incur with some confidence level. Then when we say scenario analysis, okay, that is like you create different scenarios. What would happen if interest rate increased by 1% and exchange rate depreciate by 5%? Then what would be my value of my portfolio? Things like that. But in scenario analysis, what do? We do small changes in the risk factors. That means interest rate, exchange rate, or commodity prices, or things like that. Or maybe you can go beyond that. You based on your model, you think about the GDP or other economic variables. Based on the changes in those economic variables, what would be the changes in the interest rates, exchange rates, and other financial variables? Then what would be the impact on your portfolio? Given a scenario, what would be the value of your portfolio? What would be your value of portfolio and what value of liability? So even you can do this scenario analysis even for a liquidity position. What would be my liquidity position? That can be done. In the stress testing, it is a scenario analysis, but generally what do? You create a scenario, very extreme scenario. That means instead of interest rate going by 1% or 0.5%, what would happen if interest rate goes to 0? Like now, when we were in January, if you have done any scenario stress testing, you could have done what would happen if interest rate goes to 4%, 5%. When we were at 10%, going down interest rate to 5% is a stress. Now you can think, now we are at 4%, 5% interest rate. What would happen if interest rate goes down to 0 or suddenly to 10%? That's a stress. You create a scenario with extreme movements of the variables. If what would happen, our GDP goes down, zero or negative. That means if we enter into a recession, what would happen? What would be the interest rate? What would be the exchange rate? Then what would be the impact on your portfolio? That is stress testing. It is sort of scenario analysis, but the scenarios that we have created are very strict. So this will give you this need you your computing ability. So you have to do some simulation, do a lot of calculations, but you can get ready for that sort of event. If that happens, whether I can survive, you can decide it. So we'll stop here, and next week we'll probably may not be next week. I think again next week Perry will take over and finish the ALM. Maybe week after next, or 3 weeks time, I'll be back here to discuss about risk management and continue. So we'll continue this part, and at the end you can see we have credit derivatives which we didn't discuss at the derivative presentation. We'll discuss these, and then we'll move into FX risk presentation and discuss how can we manage foreign exchange rate risk, and if time permits we'll move into how to use interest rate derivative products to manage interest rate risk. So we'll stop here. If you have any questions, now you can ask. But when you come to the next classes, even next week, I think even Perry would discuss about duration and duration analysis in ALM. So better you refresh your knowledge on those duration, convexity, and derivatives when you come to the classes in 2 weeks time, because we are going to use those products to manage financial risk. So any questions?
Yeah, this how we generate this random number, like we have to click RAM between and put the number, or like
sorry, in Excel creating random numbers.
this, yeah, yeah,
Yes, what I
yeah,
use
just
is rand.
if we put
There are different
okay,
equations, say, and so this will give, this is by default gives you random numbers between 0 and 1, and it assumes there's a distribution called uniform distribution. I think this assumes, yes, evenly distributed. That means uniform distribution. So the chance of occurring each figure is the same. It's like 1 over n. So with that expectation, this will generate these random numbers. But in this rand between, you can give a range, then say bottom and top. Within that range, you can generate random numbers. There are different ways. Even if you want to create a normal distribution, you can do that as well. Say what you have to do is give a mean and standard deviations. If I want to create a random number with mean 0 and standard deviation 1, it will give you so you have to give this will give you the probability. if you want to create normal distribution, you can use this, but you have to specify mean, standard deviation, cumulative probability, and what's the level you want, or we can create like standard normal, yes, standardized value. So there are depends on your requirement. There are ways of doing that. If you know the distribution, even you can generate random numbers based on that distribution as well. Mostly,
Okay.
for sure, you can create normal distribution figures, and then you may have to do some manipulation to convert that normal distribution into some other specific distribution. There are ways of doing that. But the one I use trend is just to generate a random number between 0 and 1.
Okay.
Any other question? So if not, we'll stop here. Thank you very much for attending the class, and so I hope you do your homework. So revise whatever you learn every week. Try to read some other extra materials as well. You have some sample questions which I have distributed. Try to answer those questions. That will refresh your knowledge on the previous topics, and that will help you to understand the new topics, because even at the beginning at the beginning of the course I mentioned all these are interlinked, so not isolated things. So you need prior knowledge to learn the next lesson. So please be in touch with all these materials. Okay, thank you very much.